Welcome back to Primary Source China Investment. This is show G6, and every week, Peng Guo and I wrestle with the binary nature of social media and videos like this, and news in general. Every time we look at something, it's either good or bad. Well, actually check that. It's either fantastic or it's the end of the world. And for the topics that we cover, nuance doesn't always translate well. But that's the exact space we need to be when we're talking about the allocation to China. The second largest economy is not going to suddenly evaporate. And similarly, it's not going to suddenly turn tail and be performing like it did for the past 15 years. It's going to maybe perform more like it did for the last 3 years. So with that intro, when it comes to the Chinese capital markets, we're in a period of both government and consumer-driven change. And today, we're going to look at both. On the government side, the Politburo has already been issuing notices regarding transparency and offering up stimulus, like the recent loan cut. Much of this is usually a word salad with very few actionable items, but there is a new head of the CSRC, and there's been plenty of articles about rule of law and pointing fingers at derivatives and program trading. More will certainly come out of the Lianghui, the 2 sessions, which is kicking off this week. But what are you hearing, Peng Guo, and what do you think about these new regulations and the new drive for transparency in the capital markets?
Yeah, I think that's definitely is the market needed, and that is the shortage for in China market for a very long time. So China Asian market, so people really hate it just for fund reason for the whoever issued the securities. It really should become like the regular transparent market rather than like the special interest group to manipulate the market.
Yeah, and on the listing side, viewers may not know that listing in Shenzhen and Shanghai is already more difficult than listing in New York Stock Exchange or NASDAQ. Companies have to be profitable. They have to have revenue. In the U.S., you can go list a SPAC if you can raise $10 million.
That's definitely true. So I think the conditions is much harder if you want to list it in China. The CSRC is more like the investors to check what's your IPO materials. I think in a Hong Kong market and much more relaxed, and also they have definitely in China market is the goal is like the protect like the small investors.
Yeah, and that's not to be lost. Wu Qing, the new CSRC head, in his first press conference meeting notes, he highlighted the insider trading and market manipulation. So I don't think he's viewing it as a company problem. He's viewing it as a behavioral problem, and he wants to snuff out some of that activity.
Yeah, most of the major financial institute already adjusted China this year's growth expectations from the 4.5 to 4.8%. But most of them is close to the 5%. So it's still keep the better growth than the last year.
Yeah, and some of the behavioral change on the investor side I wanted to highlight. So I'm not confident that mainland investors are ready for or can even handle a set it and forget it, long-term equity strategy. But recently, there's been a sort of jump ball for this CSI A50 index. Something like a dozen fund houses launched products rather successfully, and the so-called home team has been, the sovereign wealth fund has been investing in ETFs, right? They're just buying the plain vanilla ETFs on the CSI 300 and even CSI 500.
That's definitely is the bottom. So we talked about that before. So it's hard to see what's the exact day for the bottom, but the really bottom is like the area. So in those area, it still maybe have the last drop, but then the market get bounced, and the signal is very clear. It's get bounced back. So the only question is what the market will perform in the resistant area.
Yeah, the observation I was going to make though was even the home team and even retail investors are buying vanilla broad-based ETFs. They are not buying active managers. They're not buying individual stocks. They're not buying structured products. In the past, everybody used to say, oh, it's a product problem. Oh, we need some innovative product. The reality is you don't need innovative product. You need to buy
Index
good
problem.
companies, good price, right?
They follow the wrong index. If you check the current index Sharp ratio, most of them is around 0.2 and
Yeah,
0.3%.
it's
So in
bad.
those areas, if you track or buy some product that track those kind of index, definitely you have better performance.
Yeah, and the A50 caught our attention because if you just put the A50 next to the CSI 300, you're going to see a lot of comparison. The first few companies are actually the same. Maotai, Ping An, CATL, and China Merchants are and Medea is the first five holdings of each of these indexes. And the weighting may be off a little bit different, but if you look at the sector allocation, which was the reason behind the A50, it's a little bit less financials. And yeah, that's all true. But at the end of the day, performance matters. And if you look at a chart between the CSI 300 and the A50, you're going to see a very similar performance. So I don't think it's
And the
necessarily
good news is from the chart, you will see the real estate is just 1%.
that's that.
Surprisingly.
Well, also that's because valuation has been tanking, right? So when you put it in the index and you do it on a market cap based weight, you're going to get a lot less allocation to real estate. I mean, that's just a fact, right?
Yeah, this bounce back is a leading companies is really in the information technology. So
Yeah.
whatever you will see AI related sector ETF and the growth much better than any other sectors. So I think it's the bottom line is still need to find the area has the long-term growth and the sustainable growth, and then you can adjust the sector's weight. That is probably the key things rather than buy the broad ETF.
Yeah, it's a little bit more difficult. I mean, if you're looking just to allocate a little bit of your portfolio to China, it's hard to actually go in there and get your hands dirty. So that's why I think a lot of these ETFs are becoming more and more popular because it is very hard to beat the index on a long-term basis. So that's, I think, the goal of Beijing, CSRC, the regulators, is to have a more stable capital markets. I think that's the goal. I'm not sure how quickly they can get there. And with that, we're going to leave it with show G6. Thanks for tuning in, and we'll see you next week.
Thank you.